I'm Mira.
And today, we are looking at a market that is honestly just tearing itself apart in two entirely different directions.
It really is. You have this massive multi-trillion-dollar AI gold rush sending the Nasdaq, straight up.
Right, straight into the stratosphere. But then on the flip side, there's just an absolute flood of Middle Eastern oil completely cratering the energy markets.
Yeah, and caught right in the middle of all this is the Federal Reserve. They are basically terrified that this exact AI boom is going to keep inflation running incredibly hot.
So before we get into all that, let's just quickly summarize where the June 30th, 2026 session actually closed.
Right. So the S&P 500 closed really strong, up at 7540.2.
A nice solid close there.
Yeah, and the tech-heavy Nasdaq just surged to 30,489.
Wow, just massive.
Meanwhile, the 10-year Treasury note slid down to 109.62, and WTI crude just plummeted to $70.05.
Okay, so a lot to unpack today. Here is exactly what you're going to get in this deep dive. Session 1 is going to cover the pre-market setup, specifically that massive Iranian oil dump, and a very dovish pivot out of Europe.
Then for Session 2, we will dive into the U.S. trading hours. We had some really mixed consumer data and those hawkish Fed warnings that were just completely flattened by the AI infrastructure supercycle.
Exactly. And finally, Session 3 will cover the corporate events recap. You've got a notable bear getting squeezed, a look at what to watch next, and of course, our daily paper trading segment.
But real quick, before we jump into Session 1, just our standard reminder that this deep dive is strictly for market context and discussion only.
Right. Definitely not personal investment advice or, an investment recommendation.
Exactly.
All right. Session 1. What set the stage before the U.S. session?
Well, to really get this, we have to rewind a bit to the prior session backdrop. So think back to June 28th and 29th.
Right. The weekend. We had those incredibly fragile, very technical talks happening in Doha between the U.S. and Iran, specifically over the Strait of Hormuz.
Exactly. And everyone was just holding their breath, right? Like, would the blockade actually ease? But by late Monday into Tuesday, June 30th, it became undeniable.
Yeah, they didn't just ease it. They completely flooded the market.
Oh, absolutely flooded it. It became clear that Iran exported over 50 million barrels of crude oil since that blockade eased.
Which is insane. That equates to roughly 1.66 million barrels per day, just for June.
Yeah, and they were not quiet about it either. You had the Iranian parliament speaker, Ghalibaf, actually bragging publicly.
Oh, yeah, saying they are selling at Brent prices with zero discounts.
Right, no discounts at all. So obviously the market reacted immediately to this massive supply flush.
We talk about tail risk removal as a market trigger, and that is exactly what happened here.
Oh, for sure. It drove WTI crude down to an intraday low of $69.22 before it finally settled at 70.05.
But Mira, I really have to challenge the market's completely relaxed reaction to this.
Okay, how so? The oil is flowing, right?
It is flowing, yeah. But if we look at this through a game theoretic lens, right, we shouldn't view geopolitical brinkmanship as some unpredictable natural disaster.
Right, it's bargaining leverage.
Exactly. Iran is clearly using this massive oil dump to dictate terms. They are asserting total sovereignty over the Strait of Hormuz.
While completely ignoring Hezbollah de-escalation, by the way.
Yes, so the market is prematurely pricing in this permanent peace, but effectively it is a hostage situation.
That is a really fair point, Daniel. Like, they turned it on today. They can just as easily turn it off tomorrow. But for today's pre-market session, that flood of oil had a huge secondary effect.
Right, pivoting over to Europe.
Yeah, so right around 12 a.m. Eastern time, which was 9 p.m. Pacific on Monday, we saw a major reaction from Europe.
This is the dovish pivot from the European Central Bank, right?
Exactly. Multiple ECB officials, we are talking Ren, Delank, and Kazaks, they all came out signaling a likely July rate pause.
Because of the oil drop.
Yes. They explicitly noted that the swift drop in global oil prices significantly reduced the stagflationary pressure on the European economy.
Right, because energy prices are basically a consumer tax.
Right.
And with that tax lifted, it sparked a huge relief rally.
Oh, massive. The Euro STOXX 50 was up 1.55%.
Which laid down a really solid risk-on baseline for U.S. equity futures overnight.
Exactly.
So just to wrap up that part, a total flood of oil and a very relieved European Central Bank set a really bullish tone for the morning.
Yep, it sure did.
Let's take a quick break, and when we come back, we will look at how U.S. data and the Fed tried to completely disrupt this rally during American trading hours.
All right, we are back. Session 2. What moved markets during U.S. trading hours?
Well, it was a pretty wild morning because at 10 a.m. Eastern Time on Tuesday, June 30th, we got hit with a really mixed bag of consumer data.
Yeah, a total split screen. So first, the USCB Consumer Confidence Index completely missed expectations.
It came in at 91.2, right, versus the 94.4 that was expected.
Exactly. And the detail that really stood out was that nearly half of consumers are anticipating higher interest rates.
But then, at that exact same time, 10 unmet, the JOLTS job openings report comes out, and it completely beats estimates.
Right, 7.594 million job openings versus the 7.295 million estimate.
So you have a labor market that is clearly sturdy enough to prevent a hard landing.
Yeah, people are still hiring, but the consumer is clearly eroding.
I mean, we always talk about discount rates as financial gravity, and you can really see that gravity pressing down on consumers right now.
Oh, definitely. And the S&P 500 actually dipped briefly right around that 10 a.m. release.
Yeah, it dipped, but it quickly recovered because honestly, the market was just waiting for the Fed.
Which brings us to 10:52 a.m. Eastern Time.
The bombshell.
Yeah, Fed Governor Hammack comes out with a very stark warning. She pointed out that the job market is still near full employment, but core services inflation is just uncomfortably high.
But the kicker, the part that really got everyone's attention, was what she blamed it on.
Right. She explicitly stated that massive AI investments are applying upward pressure on inflation.
Which is wild to hear out loud.
It is. She basically warned that if this data holds up, current policy just isn't restrictive enough, which completely opens the door for rate hikes.
See, I have to challenge that, though. Is she mistiming this entirely? I mean, is AI capital expenditure really an inflationary force? Or is the Fed misunderstanding a technology build-out that will ultimately be deeply deflationary?
You really think it's inherently deflationary?
Eventually, yes. It's a technology build-out. Once it's up and running, it crushes the cost of services.
That is true long-term. But the physical reality of building it right now is incredibly resource-intensive, which is exactly what Hammack is looking at.
Right, but the market didn't seem to care about her worries at all today.
Not even a little bit, because just 8 minutes later, at 11 a.m. Eastern Time, Amazon Web Services dropped their own bombshell.
Right. AWS announced a $1 billion initiative. They're going to embed thousands of forward-deployed AI engineers directly with their enterprise clients.
Which just feeds right into that carryover narrative from Monday.
With SK Hynix and Samsung, right?
Exactly. They pledged those hundreds of trillions of won for AI data centers, and Anthropic secured all those massive partnerships.
It just proves that these hyperscalers view AI CapEx as a cycle-agnostic arms race.
Yeah, they do not care what Fed Governor Hammack says. They are spending this money no matter what.
And that arms race mentality just completely overrode the Fed's hawkish warnings. I mean, the Nasdaq surged past 30,000.
Proving investors are perfectly happy to ignore macro headwinds in favor of tech infrastructure growth.
Exactly. So to wrap up session 2, basically, AI momentum just completely crushed any concerns over mixed consumer data and the Fed's threats.
Yeah, it wasn't even a contest today.
All right, we are going to take another short break. When we return, we will look at the corporate recap, a famous bear getting absolutely squeezed, and check in on our paper trading portfolio.
Sounds good.
Welcome back. Session 3, Corporate Events Recap, and what to watch next.
So starting off the corporate side, we had a pretty major regulatory story hit the wires very early this morning.
Yeah, at 6:39 a.m. Eastern Time, Reuters reported that the U.S. is actively drafting an import ban on Chinese solar inverters.
Which sounds super niche, but it's actually huge. Because we always talk about power access as the physical AI bottleneck.
Right. And if you ban foreign grid hardware like these inverters, you are immediately threatening to increase supply chain friction.
Exactly. Specifically for the domestic power projects that these massive data centers desperately need to get online.
But what's fascinating is how the market traded it. The industrials ETF XLI actually rose 1.0% today.
Because domestic suppliers are going to get all that business now.
Yep. Now, moving on to probably the funniest timing of the day.
Oh boy, yeah. So at 4:15 p.m. Eastern Time, right after the bell today on June 30th,
Michael Burry strikes again.
he disclosed massive short positions against Tesla, Nvidia, and Applied Materials.
And he went long on Microsoft.
Yeah.
But man, the timing.
I know. He reveals this huge bearish bet on AI infrastructure right as the Nasdaq just rockets higher.
Yeah, the tech sector, XLK, finished up 2.6% today. And he's shorting the very pillars of it.
I mean, to be fair, there were other regulatory headwinds today. Apple is dealing with that Supreme Court appeal over the Epic App Store fees.
Right, and Amazon Australia is facing a lawsuit over Prime Video ads.
But none of those macro or regulatory headwinds even made a dent in big tech today.
Not at all. Well, folks, if you are celebrating your portfolio's tech gains today, just spare a thought for Michael Burry.
Seriously.
He just disclosed short positions against Tesla, Nvidia, and Applied Materials right as the Nasdaq decided to rocket higher. I mean, the market is completely ignoring the bears. It's a lot like how enterprise customers will soon have Amazon's AI engineers physically embedded in their offices, thanks to that new AWS billion-dollar initiative.
Oh, definitely.
Honestly, that sounds a lot like paying a tech bro to move into your spare bedroom and tell you how to run your life.
That is exactly what it sounds like.
So enjoy the green on your screens and pop the champagne tonight, because clearly this AI supercycle hasn't learned how to read a stop-loss order yet.
It really hasn't. So, with that in mind, let's look at what to watch next for tomorrow, Wednesday, July 1st, 2026.
Yeah, we have a lot of data coming.
Right. At 8:15 a.m. Eastern Time, we get the ADP employment change.
Okay.
Then at 9:20 a.m. Eastern, there is a big Fed Chair Warsh speech.
Everyone will be listening to see if he echoes Hammack's tone.
Exactly. Then at 9:45 a.m., it's the S&P Global U.S. Manufacturing PMI final,
Right.
followed right at 10 a.m. Eastern by the ISM Manufacturing PMI and U.S. construction spending.
And fine.
At 10:30 a.m. Eastern Time, we get the EIA crude oil stocks change, which will be very interesting given the Iranian dump.
Definitely.